And we're on. Hey, everybody. Thanks for coming to our show today. Agents Who Win. Todd Schroth here with my friend Steve Bell. Steve and I have known each other for quite a while. If you haven't followed us already, please follow us on Facebook, YouTube, and Instagram. Agents Who Win on all three channels. And Steve, thanks for popping on today. You know, we go back probably about 2 years now through NAHREP, a wonderful organization that's there, which we're getting that ramp back up for 2021. We're excited about that as well. So I want to kind of just talk, some tax things. And I know tax is not exciting, but there's a lot of things we need to learn about tax to make it exciting, and so we don't get in trouble. And that's a big thing, because everyone always asks, what's FERPTA? What's this? What's this? How's the new tax plan going to affect things? So it's something we really need to dive in and learn more about. So I wanted to kind of just chat with you a little bit so you can see how you can help us 2021 and how things are going.
Sure. Hey, thanks, Todd. Thanks for having me on. Yeah, actually, we did. I think it's been a couple of years now through NAHREP, and then of course we cross paths on the baseball field.
Yeah.
With both our kids, playing ball. Mine have kind of aged out of that now, but it's fun times, anyways. But it's great. There's definitely a lot of things going on. A little bit of background about my firm. Harding Bell International. We're an accounting firm located here in Central Florida. We've been in the business here since 1999. Our big focus of our firm has been working with investors, property managers, and realtors, really anything property related and those kind of transactions. That's kind of been a wheelhouse of our business, whether domestic buyers and sellers or foreign buyers and sellers, which is a bit of a niche that not many accounting firms deal with. So we've kind of been a leader in that and been blessed to be able to do that and really kind of be an expert in that area. So we can talk about really whatever you want to talk about today, and some of the things like the tax plans that may come up in the future, personal taxes for realtors, capital gains, thinking FERPTA, investor questions, all those things, incorporation, rental properties, and tax. A lot, really, what we find is that with realtors, many times they don't realize how much they're involved in tax or as part of the profession, but it really is. It's a big part of it. So
let's start out with this. So we've got a lot, ironically, with 2020 and COVID and everyone getting furloughed and other stuff, everyone's looking for second career opportunities. And so one of the big questions is, so everyone's becoming a realtor. And we want to make sure, they understand you're running a business. You're not just go stick an ad out there, go sell a couple houses and go collect the check. You are running a business. There's no one behind you taking money out, doing all that stuff. I spent my first 4 years unincorporated. And when I finally got incorporated in 2004, I realized that after a $60,000 tax mistake. And so hence the new team, Robert T. Schroth, PA, or new company, Robert T. Schroth, PA, SCorp, popped open. And since then, I've been able to cover my tax base down to minimal every year because of the way we can run it like a business. And it's also separating business from personal. Right. But what is the best one they can do? So, is it good to incorporate right away, or get started in a year or two and then do it? And then what type of corporation is the best one?
Yeah, good question. I think generally, you don't necessarily need to do it the first year unless you're going to hit a threshold, say 50, 60,000 in income. Let's face it, 90% of realtors never make that. They right. Just don't. So, but if you're in that bracket, if you're starting to make that kind of money, then it's worth incorporating, because what it's going to cost you to incorporate, the tax and accounting fees, you're going to save that and more in tax by incorporating. As you already know, Todd, I can tell you stories from back in 04, 05, 06, 08, when realtors were making money hand over fist, and they were spending money on cars and homes. And did they put money aside for taxes? No. And when you get that $60,000, $70,000 tax bill, we've had them go bankrupt because of it. So, but definitely. But I think for us, kind of a benchmark is you hit 50 to 60,000 in sales. That's a good time to start talking about that.
So with that in mind, I run an S corporation. It's a PA. Do I go and open up an LLC, or is an S corp better than an LLC for some reason?
Not necessarily. They really work pretty similar. There's some details that are a little bit different, but generally the PA, an LLC, and S corp really kind of you're going to get the same basic tax benefits because,
Okay.
and really the big one is that when you're getting all your income and being taxed on an individual basis, you're paying self-employment tax, and that's
Right.
really where you get killed in tax. So by incorporating, you can deduct a big portion of that payroll tax against your income, and that's where you're really saving the money. And you can do that in all three of those. But that's
Okay.
really where the big thing comes.
So I know, and I don't know if you want to talk on corporation stuff, or if that's more legal, more on the legal side. But like I've seen some people do the LLC with an SCorp inside of it. Is there a benefit or anything, any strategy behind that?
Good question. I mean, that may be a bit above my pay grade, but I can tell you a lot of times people think that double corporations or having two LLCs are the benefit. Really doesn't, because a lot of things are passed through anyways, and there's no necessarily benefit to have both. Now, there could be some benefits there if you're investing or you want to have, if you're a realtor and you want to own properties in something. Yes, that's some things that we can certainly talk about.
Yeah.
Specifically to that, we find that each individual person has different needs and wants and concerns. So really what we try to do is kind of tailor what the individual person needs and what's best for them. There's really no cookie cutter, thing for everybody. The same thing doesn't work for everybody structure wise.
Right. Which makes sense.
Yeah.
That's I was just wondering, because I've seen some, like, I've got the LLC with it being run as an S corp. I'm like, why LLC? Because I know we've got to be very careful too with the way our license is on our name is on our license. And if I'm going to go with the PA, then I've got to have it as my first name, last name. LLC, people try to get creative with things. It's got to be Robert Schroth LLC, I would assume, because it's got to match the license of how your name appears.
Right. That's my understanding as well.
I get messed up sometimes because I'm Robert Todd Schroth, but I go by Todd. And so everything, things get put in there as Todd Schroth. They get put in as Robert Schroth PA. You got some things as Todd T. Schroth PA. I'm like, where are you guys pulling this info from? But, and you got to be careful with it too. So it's like, you've got to make sure it's consistent across all avenues there. Yeah. So diving into that, what are, like, I've got people right now saying, hey, if you guys want to prepay your marketing into next year's bill, get this year's tax write-off. Are like expenses like that worthwhile, or is it better to just keep the expenses for the tax year inside that tax year?
Yeah, I'd say generally you can prepay. I guess it depends on if you're planning to maybe say you're trying to reduce your tax bill for the current year. Yeah, it wouldn't hurt to prepay it. It's kind of a 6 of one half dozen of another, as far as, which year you want to do. And you may think you're going to have more income the next year. Maybe you want to hold it over. Right. Speaking back to what you said about, thinking back a little bit, you mentioned I can't remember what my train of thought there, but something about the picture that I don't know where you picked the picture of from me, for my headshot for this, but it looks like it came from like 15 years ago. So I look like the typical realtor. You give them the card, you look at the face, you're like,
so prepay your pictures ahead of time. So
yes, exactly. Yeah.
I just got my new headshots today, so they'll be updated.
Yeah, that was probably 15 years ago or something. So I have to congratulate finding that one.
Yeah, I'm like, man, he looks like a kid. I'm like, yeah. When I was there this morning at the photographer studio, I'm like, can you get rid of the puffy eyes and the allergies, and can you add in a little, double chin or take that away? And that's awesome.
Exactly. So exactly, incorporating tax wise. You mentioned deductions. I mean, there's really a ton of different deductions that realtors can take. I think many don't know what they can take, and especially if you're making good money as a realtor, you need a good accountant, someone that knows what they're doing, whether it's us, whether it's somebody else. I mean, there's some great accountants out there. There's some really bad ones. Generally, CPA who has experience with real estate agents is someone you want to go with. But you have things like your car expenses, and you can deal with that in two methods, whether mileage or actual expenses. And sometimes if you have an SUV and maybe you have a wrap on the car, that sometimes is better to take actual expenses. For example, and you can take home office deduction, your meals, travel, health insurance if you're incorporated. You can deduct things like that, equipment. there's a kind of an unknown thing too. You can actually hire your children, and for like, I think last year it was a max of like $6,100 a year. As long as they're doing, related things for your business, you can deduct those wages, and then they can invest that money, say in an IRA, and you're getting even more deductions. You're saving money for them.
So here's a question on that. What age? I'm just thinking for my kids, they're soon to be 13 and 11. What is the capacity of what they can do, and how much can I pay them? And I guess can I pay someone at that age a cost like that? I mean, is it modeling?
Yeah, I think you can. There's really no limit there. As long as you're paying them a comparable wage. For example, if the wage to do social media is $8 an hour, then you pay them $8 an hour. Up to I think last year was up to $6,100. I'm not sure what it is this year. I didn't look back on that one. So there's some benefit. Another added benefit too, for if you hire, say your spouse doesn't work, maybe she works alongside you some, but doesn't really get paid.
Right.
You can hire your spouse, and then, for example, when you go on trips to conventions and so forth, her expenses can be deductible as well.
True.
So there's some benefits there, and there's other things that some trade secrets a lot of people don't know about, that a good accountant can guide you along on those kind of things. So,
I mean, I hired my accounting firm back when I was 18, and I'm still with them. And 19. Sorry. I bought my first house at 19 years old, and when I looked at the closing statement, I said, "There's no way I'm doing this tax return." There was the best $300 I ever spent. This is back in 1996 when it was a lot cheaper.
Right.
Or 95. And then I started buying and selling properties. So it was like, I did not want to do that on Quicken or TurboTax or whatever it was. The best money that I can do, I just email everything to you guys. You email a report back. It's done. And, I honestly opened the envelope up and said, that's it. Oh, I'm getting a refund. Cool. And best money spent. I mean, it's because our money's made selling houses, not bookkeeping.
Exactly.
I'm going through all that. So, because it is a drain.
Yeah, I completely agree. I mean, we hire a marketing firm that does things for us because we're not a marketing firm. We're an accounting firm. I mean, there's some things we do social media wise, but our expertise is accounting. So we don't. Why do marketing when our expertise is accounting? Why do accounting when you're a real estate agent? It doesn't really make any sense. So,
now I've got one of my team members who does our bookkeeping for us, and I get a P&L every month so we can see what's going on. You have to run it like a business, and you need to look at the avenues that are going out. You need to know what your spend is on your marketing. So if I'm spending $5,000 on Zillow, am I making $30,000 on Zillow?
Right.
If I'm spending $500 a month on Facebook, am I making $5,000 a month on Facebook? What is your ROI on each one of those leads that's going out too? And people don't look at that, and they're like, I've only got, I'm spending $15,000 a month on marketing. I'm making $100,000 a month. Whatever the numbers are, it's all working. But what if that $5,000 budget could have been put towards the other avenue? Let's take it from Zillow to Google, and all of a sudden Google's giving you a 10-to-1 versus a 3-to-1. You wouldn't know that unless you were looking at where all your stuff is coming from.
No, exactly. It's important. Like I said, you're running it as a business. Why waste, that money when you can, move it somewhere else if it's going to make sense for you and make you money elsewhere.
So let's side to another question that I think is more scary than exciting. FERPTA.
Yeah.
There's a seller's disclosure. I always ask my sellers, 90% of them are U.S. citizens. Are you a U.S. citizen? And they look at me and start laughing. I'm like, no, it's a serious question. I have to answer this. Are you a U.S. citizen? Because if not, then we're going to hold back 15% of your funds. You're like, huh? How does that affect a buyer side?
Okay. Good question. Honestly, you are rare breed, Todd, to actually ask that question, because most agents don't even know to ask that. And it's more than just being a U.S. citizen. You can be a U.S. resident on different types of visas and still not be subject to FERPTA, but you wouldn't know that. But that's like I said, most don't do that. And then what happens, it comes to closing and the title company says, oh yeah, we got to withhold 15%. And the reality is sometimes people don't get the money back for a year and a half because of that. So, and you don't want that to happen to your sellers. So you mentioned about the buyer side, on the buyer side, technically, and without going into too much technicality, For those who don't know what FIRPTA stands for Foreign Investment Real Property Tax Act. In essence, that means whenever a non-U.S. resident, for tax purposes, sells a property, there's a requirement to withhold typically 10 or 15% back for tax in case capital gain tax is due. The people or the party that is required to withhold that money, technically by IRS standards, is the buyer. So, Todd, if you're a foreign national and I'm buying the property, I'm actually required to withhold the money. Do I, as a buyer, know what FIRPTA is? Heck no, nobody knows what that is, except some nerd accountants and maybe some title companies. So, what has to happen then essentially is and it's kind of crazy because that's the IRS for you. Really, it's the seller is the one that really sets up the FIRPTA withholding. They have to provide things. We have to get information from the buyers, and then you need a good accountant that's going to actually handle the FIRPTA paperwork to kind of make that transaction smooth. And especially in the age of COVID right now, the IRS is moving slow. They're behind by months and months and months. So it just makes it more difficult. But without going into a lot of detail, our firm does roughly 800 FIRPTA applications a year. And the IRS has actually told us we do more than I think any other accounting firm in the U.S. And that's basically because we're here in Central Florida with bazillion non-residents with vacation homes. So we're kind of in the epicenter of vacation homes for foreign nationals.
So we just did one. A lot of when I'm doing the buyer side, if it's a foreign national, like I'm in North Orlando, so we don't have as much of the foreign national. But there was one recently where it was a rental, and the guy was in South America. My client was buying it, but it was for their daughter to live in. And the question, are you going to occupy the property? And you have to occupy it for 2 years or a direct family member. And it got very sticky with the direct family member. And they called me a year later to sell it. And I said, well, given the fact that you guys moved down here, made a homestead and some other stuff, let's sell it a year later. And, so we are beyond that 2 years that's there.
Yeah.
Okay? And I don't understand why they put it on the buyer's responsibility, because it's like it has nothing to do with the buyer. But it got scary because I'm like, I don't want to be responsible for their 15% tax that they had to pay or didn't.
Yeah. Well, on those cases, generally the IRS is lenient. If your intention, for example, is to live in the home for 2 years, then you get a job change and you got to move, or say there's an economic hardship, the IRS is going to be lenient on that, especially if they've handled the FIRPTA or if the people filed tax return and paid any capital gain due, or if there isn't any. But it is kind of crazy that the buyer is responsible for that. But we've have had situations where FIRPTA has not been handled correctly, and the buyer then gets a whopping tax bill for like $35,000. Usually we can get that worked out because it was a mistake. But those do happen. But it's crazy that it's the buyers. It doesn't make sense, but that's the tax code, and that's the IRS for you. Yeah, exactly.
Well, I sold a vacation house down by Disney back in February. That was another question. Was FIRPTA again, South American seller? I have a California buyer, and like, you're buying as a vacation home. There's not. I mean, it is what it is. Just
it is what it is. Yeah. Another thing too. Many times, Todd, that if FIRPTA was handled incorrectly or wasn't done when it should have been done, for example, if you bought it as a foreign national, and you bought it from a foreign national, and FIRPTA wasn't handled correctly, when you go to sell to the foreign national, that money has to be sent directly to the IRS if you can't prove that FIRPTA was done. There's, and in the past that was the problem. Now not so much, because they've been done correctly over the years, and we've helped educate a lot of the title companies and realtors with classes and seminars throughout the year. So
no offense, but the title, I know there's a handful who are great at what they do, and there's a handful that honestly are not. And I run into some that we're educating them, and they're like, no, this is not how we've done it before. I'm like, do you want my buyer to sign something that says he's going to be responsible for the seller's taxes? Like, we already said in the beginning we're not doing this, and you guys are Dave Closing trying to hold us up. They get the sellers to go ahead and hold the money up, and we're signing something, to our side. And the escrow agents are so poor of explaining it and trying to play legal on it, and we'll walk away, because if he gets reloaded, I mean, there's, like you said, there's certain things that can happen that we can get away with it, but or get around it if they got relocated or hardship or something. But I would not have bought that house if I had known that something like that could have come up.
Yeah, and there's some good, and there's good title companies that really handle FERPA well. There's others that are so. There's some that are terrible. Without naming any names, I'm not gonna do that here.
Yeah, no.
but we probably all know who they are. But yeah, FERPA can be a sticky thing, and that's what we're here to. We're here. We try and support realtors and transactions. We want them to go smooth. So we're always, even if I don't have they're not my client, I'm happy to answer questions for people.
So Holly's asking a question. This is a totally, kind of side to another topic here. You purchased a car under Section 179 3 years ago. At what point does it no longer serve you for deduction purposes?
Well, she's going to ask me a question with how long is it depreciated? I think it's like a 5-year depreciation on that.
Okay.
So I think that's 5 years on depreciation, but it depends. I guess it would depend on too how it's being handled. Whether are you doing actual expenses or mileage? So if you're doing actual expenses, I mean, you really through the life of the car, because you can use if you have breakdowns and things like that. One key thing too is that you want to keep mileage records if you use it personally.
Right.
For any personal uses, because that's important regardless of which way you go.
Right, makes sense.
Yeah.
So if I'm trying to write a car off, and you talk about doing a wrap on it, if I just do magnets on the side and maybe the back window, do I get the same write-off potential as if I wrap the entire thing?
I mean, it's essentially the deduction. I mean, you're not necessarily going to write off for the whole thing, but it's if you can, like I said, there's two ways to do that. You can go with actual mileage, or you can go with the what's the word I'm looking for? The two methods, actual or the mileage deduction.
Okay.
If you're going to go with the actual expenses, yeah, you can pretty much write off pretty much the whole thing over time. It's just a matter of, usually an SUV or bigger vehicle, more expensive vehicle are the ones that make more sense than say a smaller car or something like that.
Gotcha. Okay. I remember back in I think it was 2004 where a lot of the agents I knew that were successful and didn't take buyer's run anymore. They had them follow them. We're all driving like Jaguars and Porsches and stuff. Right. And all of a sudden they start pulling up in Hummers and Escalades. And I'm like, yeah. What happened? He goes, $75,000 tax write-off right there. I'm good.
Exactly.
I'm like, yeah, you're not a farmer, but hey, I'll go buy one.
Exactly. I mean, yeah, why not take every deduction you can take? Why not? Absolutely.
Yeah. It was just funny. I'm like, you're getting out of your little two-row convertible into a friggin' Hummer, but hey, it works.
Yeah.
What markets do you guys service? Are you all across the nation, or are you just strictly Florida?
Well, of course we're located here in Central Florida. We have 3 locations: Kissimmee, Auburndale, and Lake Wales. We primarily are here in Central Florida, but we do have clients. We can serve all 50 states as far as U.S. tax, and we do have clients all over. I'm not sure if we have 50 states that we have clients in. I do know that on the international side, we do taxes for foreign investors, and we have, I think, clients from 120 different countries around the world. So we handle their U.S. tax and really anything that's foreign related. People maybe that are domiciled here in the U.S. or they're living in the U.K. and they're a U.S. citizen. We do that. But yeah, anything in the U.S., any state, any city tax we can do.
Awesome. So here's the 2020 question.
Yep.
What's going to happen with the Biden tax plan?
Hopefully nothing, but let's talk about that a bit. I mean,
2021 question.
Yeah. Well, I can kind of go some of the highlights. The question is whether, let me go through some of the, I'm going to put my glasses on so I can read my writing, which I may not be able to.
2,000 pages of fine print.
Yeah. Some of the highlights are they're going to repeal the Trump plan for high income filers, impose a 0.4% Social Security payroll tax on wages over $400,000, increase the corporate tax rate from 21% to 28%, and there's a temporary increase in the child tax credit, which could be a good thing. Estate tax up to 45%. Also credits for, there's some good things I think that are mentioned. Credits for workplace like retirement plans. Another thing is kind of, I feel it's a negative, and I think could affect the real estate industry would be it eliminates a step up for capital gains. Generally, with capital gains, the first 40,000 is not taxable. It would, and then it goes up each step, and you only pay tax on that next step. Well, that according to that plan, it's going to eliminate that.
So if I'm a property flipper, for example, and I don't 1031 my stuff, and I go and make a $50,000 profit, they're going to tax me 50 grand versus just 10.
Right.
Okay, that's going to be
exactly. It's essentially yes. And what would happen, according to some of the things I'm reading, is that it would reduce income on the top 1% by like 7.7%.
Okay.
And then the rest, the other 99% of us, maybe you're in the top 1%, Todd, I don't know, but the rest of us are. It would reduce our income by like 1.9%. It would decrease gross domestic product by 1.62% and lose like 542,000 jobs. My opinion, and this is, take it for what it's worth, is that to increase taxes right now during COVID and an economic downturn will be political suicide. I don't believe that would be pushed through it anytime soon.
Okay.
Just because it doesn't make sense, and people are already struggling financially. And I think maybe that plan came out to maybe, encourage some of the base to vote for him. A lot of people like higher taxes for what they want, more government. But the reality is, okay, a billionaire that makes another $400 billion, or say maybe makes another $1 billion, he's not putting that money in the bank. He may be buying a yacht. He may be buying another home, but somebody's got to build that home. Somebody's got to build that yacht. And, so it's creating jobs. Now I'm going to get on my soapbox now, and no political there, but that's just, I don't think people understand how economics really work. Is that if I make another 100 grand, that's probably not going to go in my bank account. It's going to go to investing, and it's going to stimulate the economy. So I'm not a big fan of, more taxes. But I understand where people come from on things like that. So,
the more we can keep in our pockets, the more we can reinvest. And
exactly.
Wealth, and obviously wealth creates more opportunities. And so that's why I like, as I was, when we were talking on the phone earlier, our goal in 2021 is to double our business. And if I double my business, I double my income, but I also double my expenses to double the income. So I'm going to be spending more, hiring more services, doing more things, step up, other housing, other things that are out there. And so is it worth it? Or, do I scale at the same position that I'm at right now because I don't want to go from 20% to 40% taxes or whatever my tax rate is?
Yeah. I think, looking at the calculation, you kind of joked about this. You want to make 40 million this year or 100 million. If you make an extra 60 million a year, you may be paying another $1.5 million in tax, but you know what? You still have another, 48 or $58.5 million in your pocket. So it's worth making that money. It just really is.
Right. And it's a matter, you're but like for me, I want to create more jobs, I want to create more opportunities, and because if we do scale, we're going to hire more staff that's going to be part of that. The other part you mentioned, the corporate tax rate, and I don't even know what ours is, and I should know this, but as an SCorp, what would our corporate tax rate essentially be?
Yeah, I think. Well, right now, I think their tax rates for corporations are capped at 21%. That came out in the 2017 tax plan, and the idea for under Biden's plan, it would increase it back to 28%. Traditionally, tax rates for corporations in the U.S. are higher than around the world. Our individual rates are lower, but our corporate rates are higher, and it really kind of hurts investment into the U.S. because why would you want to come to the U.S. and start a company if the corporate tax rates are higher? So, but yeah,
hence why a lot of the bigger companies are headquartered out of the country with offices here.
Exactly. And and under that plan, I didn't go talk about that. Under the plan is that like the U.S. companies with foreign subsidiaries, it's going to increase. Double the tax rates on those foreign subsidiaries under that plan. So, but we'll see what happens. Like I said, I think it's political suicide to increase taxes, but we'll see how the winds go through this. But once the economy kind of continues an upward trend, we may see a change in that. We'll just have to see. So.
I was talking to a lender the other day, and he said we're looking at probably another 2 or 3 years before we see some economic recovery, just from the 9 months of downfall that we had. So we should still see some growth in things. And I know they're talking about another stimulus plan right now that is favored or not favored. I couldn't quite catch the news when I was driving this morning. But it's you got to keep the systems going, so it keeps us out there, because if you can't keep the real estate market going, then I think it's a big thing. It's a big factor which keeps all industries rolling. Yeah,
and you know what? We've all lived through different administrations with different tax plans, and if you're smart and savvy and you just do your business, you're going to make money. You're going to grow. We've been fortunate. We've grown through the years, and it's just by just doing a good service and taking care of people, as you've done with your business. And that's just what it's
about. No matter what, as long as you take care of your client, it doesn't matter what the market is. My mom, who's all my parents are in real estate, and 50 something years now as an agent, I asked her, I'm like, with all this, with the change of what's going to come, do we scale or do we stay? And she's like, don't even worry about it. Obviously over 50 years, you've seen a lot of ups and downs in the real estate markets. And so asking for experience, and I'm like, I just need to hear that, because it's scary, because you're spending a lot of money in growth right now up till November 4th. What's going to happen based on the last 4 years? And it's like, you just got to keep going. I mean, you can't live your life, every 4 years at a time.
No, absolutely. Absolutely. So yeah, I mean, there's always tweaks and things happen, tax rates change, but by and large, they don't, I don't believe they really affect people, most of us, we just continue on our lives and keep working and doing the things we do good, and you're going to benefit from it.
Right. Figure out a way to take advantage of whatever the economy is at the time, whatever the tax plans are at the time, all that stuff. Figure out how to pivot around those.
Yeah, exactly. Exactly.
Cool. Any other closing? I'm going to wrap up. I was wondering, anything else you want to talk on tax, and then.
No, other than just the fact that, if I could share a little about what we do. I mean, we can just as a firm, we can assist, foreign and domestic sellers with capital gains calculations, entity setups, whether LLCs, prepare FERPTAs, get ITIN numbers for people. We can do business plans, refer out to, other industries like attorneys and immigration, that kind of thing. And if anybody's listening today, if you want advice, or we're here to help you. We're here to help your clients. We want to make your transaction smooth. If I can be of service to make things better for you and your clients, happy to talk to you. And even if it's just a question, don't need to be our client. Happy to answer them and help you out.
So you guys used to do a lot of trainings in person. Are you guys still doing stuff, regarding tax and FERPTA and other stuff?
We're starting to do on a couple in person, not here in the office. We want to be careful of that, but we've come to some smaller office. But we do some Zoom training still. If anybody wants that, we can arrange that for you. But yeah, we're definitely available for those kind of things.
Cool. Yep. Well, I appreciate it, Steve. We will see you at the next NAHREP meeting, whether it's Zoom or in person, and we'll be there. Everyone, thanks for tuning in. Check us out next Friday, agentswhowin.com, and on Facebook. Appreciate it.
Thanks.